Welcome back to We Get Macro. We're going to continue our videos about money and banking. If you remember from the last video, we stopped pretty much by analyzing a bank's depository institution example of balance sheet. Okay, so looking through this Wahoo bank balance sheet. Okay, so if you please watch the previous video if you have not, so you can catch up and see where we are right now. But just showing you guys here, we're going to continue to explore how to evaluate a bank, right? So kind of what I finished on last video, but I wanted to now further digest that idea and understand is the idea of how to evaluate a bank, right? Which is going to come from checking its performance through the net worth. Okay, so if you remember, net worth here is net worth. It's assets minus liabilities, right? And that means then if the net worth is positive, and that means that that bank is in good shape. It's solvent, okay? In other words, if the bank has enough things that it owns that it can then sell to pay back all of its debt if necessary, and it still has at least some money left, right? It's a positive net worth, and the bank is considered solvent, it's not in trouble. But when the bank does not face that situation, when even selling all of its assets is not able to pay for all of its debt, all of its liabilities, then we're facing a situation where the bank is insolvent, okay? And that's extremely worrisome for the Federal Reserve. Okay, bank being insolvent means it cannot pay for all of the responsibilities that it has with its debt, and that means it's failing. Okay, so that's kind of how we're going to see whether banks are failing. So let's stop and see, have we understood at least how to manage exercise when we get the information about the balance sheet and be able to predict, hey, what is total assets, what is total liabilities, and can we then make a conclusion about whether a bank is solvent or not, it's in good shape or not. Okay, so please pause the video now and try it on your own. See if you can get you the answer, and then we'll come back and solve it together, okay? Okay, so welcome back, and hopefully you had time to, and you were able to guess the conclusion to this exercise, but if not, don't worry, we're gonna solve it right now. Okay, so the first thing is, remember we're talking about in class, right? First thing is read the problem, read it thoroughly, make sure you're not trying to answer it before the end of it, because maybe there's information that's important that you're skipping. So after that, do a bank of the information given to you, okay? Which is based on the proposed question. Okay, so in this case, Stealth Bank, just an example of a bank, has deposits of $600 million, okay? So we know in this case the deposit is considered as a liabilities, right? Because the bank owes that, okay? So I already can little build here that one of my liabilities is deposits, right? Which is, in this case, we know it's 600 million. Okay, that's the first thing. Let's see what else the question is giving me. It holds reserves of $30 million and government bonds worth $80 million. Okay, now if you remember, what are reserves? Reserves of those are required to be kept by those banks. We're going to explain the role, specific role of those, especially in the next slide. But we know based on our previous conversation that we know that reserves are assets, right? It's something the bank owns in this case. So if we start building our assets here, and I'm assuming they already read the problem, right? Which you know that it's asking what is the total assets of that bank equal to, and also asking whether that bank is in good shape or not. Okay, so we already know, at least we started building the liabilities, and let's start building assets, and we know that reserves are going to be counted as assets based on what we talked about so far, right? So I'll go ahead and add that in terms of our assets. What about bonds? Well, we know that government, that those banks own those bonds, so they're going to be getting the payments from those interests, right? They're the ones lending that money out, right? So if they own those bonds, and that payment's going to come back to them, you know that in this case, this is also an asset, right? So it's going to be $8 million of bonds as well, right? And lastly, you also say that the bank, if the bank sells its loans at the market value of $400 million, will be total assets. So our loans, assets or liabilities for the bank. Well, we usually think about them being liabilities for all of us, but in terms of the bank, it is actually an asset because we're paying the bank for the loan that we took, right? So it's actually an asset for the bank. And we know the current value here in the market is going to be 400 million. Okay, so if you solve that, you're going to get it as $510 million in assets in the economy, right? So we know we're either looking to A or D. So it's a matter of knowing whether the bank is insolvent or not, right? So then we just have to calculate the net worth, which allows us to determine whether that bank is solvent or not. And we know it's going to be assets minus liabilities, which is going to be equal to, as you can see, I wrote a little too fast there. And let me go back, keep it open again so we can correct that. Okay, and let's just crash that. And just assets, we know we have $510 million, right? Minus $600 million of deposits, which is our liabilities. Okay, so in this case, if you solve for the net worth, you know that the bank has negative $90 million in terms of net worth, which makes it insolvent. Why? Because insolvent banks have net worth smaller than 0. Okay, so that's how we got to the conclusion here. You and then be able to say that the answer is D. Okay, hopefully it was pretty clear and you guys can move along as well with that exercise, but let me know if you guys have any questions. Okay, so let's further explain what's the role of reserves here. Okay, so reserves are extremely important. The reason why the Federal Reserve requires banks to hold reserves, which is a portion of its deposits, okay, is so it can then be able to serve its depositors when they want to withdraw money. Okay, so the current reserve ratio is 10%. So this connects what we have explained since the beginning of the semester when we talked about, hey, banks take deposits in, they don't keep all those deposits, right? We're going to explain how this is called fractional banking system in a second. If they don't keep those deposits, right, all of them, they keep just part of them. But that means if everybody goes get their money at the bank, withdraw their deposit at the same time, they're not going to be able to because the bank loaned part of that money out. Okay, so the idea of setting a minimum required reserve ratio for those banks is that it forces them to have a certain amount of a level of cash of money in their accounts that is available for those depositors to withdraw without having risks of facing those bank runs that we explained before. Okay, so that's kind of the goal. We want to avoid bank runs, which is a big problem before the Federal Reserve was created, as I mentioned before. Okay, so you can see here a quick idea about how that works, and you can see here explain that 10% of deposits is what the required reserves are. But you also know, and I hope you remember before, that this is a requirement. There's a minimum requirement, but banks can hold more than that. Okay, and that's going to be extremely important. So just kind of summarizing, what is that fractional reserve banking system that I'm talking about in one picture? Okay, deposits come into the bank, as you can see here. Okay, from those deposits, that's going to be all that the bank is seeing here, the entire block, both loans and reserves. But you know that part of those deposits is going to go towards loans, and we know that at least 10% of deposits will become reserves. Okay, but it can be more than that. Okay, and that's going to be play a huge role moving forward. So I just wanted to recap once again what is the bank run. We have talked about it in class before we started doing the online videos when you guys ask questions. But let's actually emphasize another way in this chapter. Okay, and I love when you guys ask questions ahead of time. It really makes me see that you guys are thinking through about the things that we're learning and are interested in our topic, which is awesome. Okay, because you can see this is extremely applicable to our lives. It really matters whether we understand the economic situation of a country, because it can definitely impact not only our personal consumer decisions, but also our employment. Also, if you own a business, your business, government, how government behave in terms of policy, the central bank as well. Okay, so hopefully this is becoming clearer and clearer as we move along. Okay, but the idea of the bank failure is that idea that we mentioned before. When people lose trust on financial institutions, they don't think they can leave their money there because they get scared they're going to lose it. So if one person goes to the bank and try to take their money out and they can't, and they go out and say, hey, I just try to get my money out, and the bank didn't allow me to. If the idea is that people would start freaking out, right? They would lose the trust and they have in these financial institutions to leave their money there. Okay, and this is what's going to lead those institutions to be in trouble, because if everybody goes get their deposit at the same time, I want to remind you, they don't keep all their deposits in there, right? They just, what they have in the bank to give back is the reserves. So if the amount that is trying to be drawn is more in the reserves, that bank's not going to have it. Okay, and that has happened before, as I talked before. Okay, especially in the early 1900s. All right. The only types of the bank runs not only happen into checking accounts. Okay. It can only happen. It can also happen to investment banks. Okay. So that's what happened in 2007 and 8. We're not going to expand too much this idea since we're still building up our blocks of the principles of macroeconomics. But if you're interested, feel free to let me know. I don't mind diving into our virtual class about how the Great Recession caused the investment bank run. Okay. So just let me know. Okay, so how is this reserve required ratio set? Okay, so the Federal Reserve is the one that is deciding this, and it's simple. It's just going to be the required reserves, the total level. So this is the level formula. So the total level of required reserves, right, is going to be equal to the reserve ratio, which, like I said, it tends to be 10%. But importantly, we're going to express that in decimal units in our formula, okay? And we're going to multiply by the total level of deposits of the bank. That will give us the required level of reserves in terms of dollars that the bank has to keep in its vaults to be able to fulfill its function as when depositors come in to withdraw that money. Okay. Now, can banks hold more than that? Yes, they can hold what we call excess reserves above the required minimum reserves that the Federal Reserve stipulates for those banks. Okay. Especially since 2011, because the Fed, one thing that we have learned in our class, the economy evolves over time, and so does policy, right? And one thing that the Fed decided to change in terms of its policy is being able to offer interest on excess reserves, right? So the idea here is that, hey, if I offer interest on excess reserves, if I offer a return for banks that hold more reserves than necessary, then now maybe I'm not incentivizing banks to be so risky because I'm offering them some type of return besides that zero return of leaving that money sitting there in case they don't loan out, right? So if the minimum required is 10%, but they hold 12%, now they're earning a type of interest that the Federal Reserve pays them for the extra 2% they're holding for those reserves. Okay, so it's another way to incentivize banks to not get too risky. As you can see, that's a problem. And regulatory institutions are trying to adjust their policies, their regulations to help to promote a safer banking industry, banking system in the U.S. Okay, and the excess reserve is going to be simply the total reserves that we have minus the required reserves, which are calculated above. Okay, now we're going to move into the money multiplier and how the banks create money, and we're going to do that in the next video, which is something extremely cool to talk about, and hopefully you open your eyes to how the banking industry can impact our economy even more. Okay, so see you in the next video. Bye, guys.